The UK housing market has just witnessed something nobody saw coming. While economists were busy predicting modest declines and soft landings, the reality unfolding across Britain tells a completely different story. House prices aren't just falling, they're collapsing at a pace that's catching even the most seasoned experts completely off guard. What's happening right now across British property markets is sending shockwaves through the entire economy. And if you own property or you're thinking about buying, what comes next could change everything you thought you knew about UK real estate. Make sure you hit that like button and subscribe to Property Reporter so you never miss the latest updates on the UK housing market, economy and property news that actually matters. The numbers coming out of the latest housing reports are absolutely staggering. In just the past 3 months, average house prices across England have dropped by 7.2%. That might not sound catastrophic at first, but here's what makes it terrifying. That's the sharpest quarterly decline recorded since the financial crisis of 2008. We're not talking about a gentle cooling or a minor correction anymore. This is a full-blown market contraction happening in real time, and it's accelerating faster than anyone predicted. Estate agents across the country are reporting that properties which would have sold within days just a year ago are now sitting on the market for months with no serious offers. The momentum has completely reversed, and sellers are starting to panic. What makes this collapse even more remarkable is how confidently experts dismissed the warning signs. Go back and look at forecasts from major banks and property analysts from just 6 months ago. The consensus was clear: house prices would decline gradually by maybe 3 to 5% over the entire year. They called it a controlled correction, a necessary adjustment that would keep the market stable. Those predictions now look embarrassingly optimistic. The market didn't just miss their targets, it blew straight past them at speed. Some regions are seeing double-digit declines already, and we're only partway through the year. The experts got it wrong, badly wrong, and homeowners are paying the price for that miscalculation. The question everyone's asking is what actually triggered this dramatic downturn. The answer isn't simple because multiple forces have collided at exactly the wrong moment. Interest rates have climbed to levels not seen in 15 years, which has made mortgages eye-wateringly expensive for anyone trying to get on the property ladder or remortgage their existing home. When your monthly payment suddenly jumps by £400 or £500, the decision to buy becomes impossible for thousands of families. At the same time, the cost of living crisis hasn't eased up. Energy bills remain elevated, food costs are still climbing, and wages simply haven't kept pace with inflation. People are being squeezed from every direction, and property has become the unaffordable dream rather than the achievable goal it once was. Demand has evaporated, and when demand disappears, prices follow. But there's something else happening beneath the surface that's making this crash particularly brutal. For years, property investors and buy-to-let landlords have been propping up significant portions of the market, especially in urban areas and city centres. Those investors are now heading for the exits. Tighter regulations, higher taxes on rental income, and increased mortgage costs have made buy-to-let far less profitable than it was during the golden years. Landlords are selling up in huge numbers, flooding the market with properties at the exact moment when buyers have vanished. This creates a vicious cycle where more supply meets less demand, pushing prices down even further. And once prices start falling, potential buyers hold back even more because they're waiting for the bottom. Nobody wants to catch a falling knife, especially when that knife is worth several £100,000. Regional variations are telling an even more complex story. London, which has always been seen as bulletproof when it comes to property values, is experiencing some of the most dramatic falls. Properties in zones 2 and 3 that were selling for absurd premiums just 18 months ago are now being discounted by 10, 15, even 20% in some cases, and they're still not moving. The international buyers who once drove London's luxury market have disappeared completely. Uncertainty around UK economic stability, combined with global instability and currency fluctuations, has made British property far less attractive to overseas investors. Meanwhile, in the North and Midlands, the situation is slightly less severe but still concerning. These areas never experienced the same bubble-like growth that London did. so the falls are less dramatic in absolute terms. But for homeowners in these regions, losing 10% of your property value is just as painful. First-time buyers are facing an impossible dilemma right now. On one hand, falling prices should theoretically make homes more affordable. On the other hand, mortgage rates have shot up so dramatically that the monthly payments on a cheaper house are often higher than they would have been on a more expensive property 2 years ago when rates were rock bottom. The calculations simply don't work out in their favour. Getting approved for a mortgage has also become significantly harder because lenders have tightened their criteria dramatically. They're terrified of lending into a falling market because if prices keep dropping, they'll end up with loans that exceed the value of the properties they're secured against. Young people who have been saving for years to get that deposit together are now stuck in limbo, watching prices fall but unable to take advantage because the lending environment has become so hostile. The government's response so far has been notably quiet, which is raising eyebrows across the property and finance sectors. Typically, when housing markets face serious turbulence, there's some kind of intervention, whether that's adjusting stamp duty, offering help to buy schemes, or implementing measures to support struggling homeowners. This time, silence. Some analysts believe the government is actually welcoming this correction because property prices in the UK have been detached from earnings for so long that it created an affordability crisis. If prices come down significantly, perhaps that makes housing accessible again for average working families. That's the optimistic view. The pessimistic view is that the government doesn't have the fiscal space to intervene meaningfully because public finances are already stretched to breaking point. Either way, homeowners feeling the pain of negative equity and falling values aren't getting much support from Westminster. Commercial property is also getting hammered, and this might be the most underreported aspect of the entire crisis. Office buildings in city centres are facing a reckoning as remote and hybrid work have become permanent fixtures of British work culture. Companies are downsizing their office footprints or abandoning them altogether, and landlords are left holding properties that generate far less rental income than they used to. Retail property has been struggling for years thanks to the growth of online shopping, but the current economic environment has accelerated that decline. Empty shop fronts are becoming the norm on high streets across the country, and the capital values of these properties are plummeting. This has serious knock-on effects for pension funds and investment trusts that hold large portfolios of commercial real estate. When those assets lose value, it impacts returns for millions of ordinary savers who have no idea their retirement funds are tied up in struggling property investments. Mortgage prisoners are another group suffering silently through this collapse. These are homeowners who took out mortgages years ago, often before the financial crisis, and are now trapped with lenders who no longer offer new products or competitive rates. Because property values are falling and lending criteria have tightened, these people can't remortgage to get better deals. They're stuck paying high variable rates with no way out, watching as their monthly payments climb while the value of their home shrinks. It's a nightmare scenario, and there are tens of thousands of families across the UK in this exact position. They're not making headlines, but their financial distress is very real, and it's contributing to a broader sense of housing market anxiety. Banks are quietly preparing for the worst behind closed doors. Internal stress tests are being run to assess what happens if property prices fall by 20, 25, even 30% from their peak. While those scenarios might sound extreme, they're not impossible given the speed and severity of the current decline. Provisions for bad debts are being increased, which means banks are setting aside more money to cover loans that might go bad if borrowers can't keep up with their payments. This is standard risk management, but it also signals that financial institutions are genuinely worried about what comes next. If house prices continue falling and unemployment starts rising, which some economists are now forecasting, we could see a wave of mortgage defaults that puts real pressure on the banking system. We're not talking about another 2008-style meltdown yet, but the risk is there and it's being taken seriously. Homeowners sitting on variable rate mortgages are living on a knife edge right now. Every time the Bank of England announces an interest rate decision, there's a collective holding of breath across the country. For those whose mortgage payments adjust with the base rate, Even a quarter-point increase can mean another £50 or £100 on the monthly bill. When you're already stretched thin, that's the difference between managing and going under. Fixed-rate mortgage deals that are ending this year and next are another ticking time bomb. Hundreds of thousands of households locked in ultra-low rates of 1 or 2% back in 2020 and 2021. Those deals are expiring, and when they remortgage, they're facing rates of 5, 6, even 7%. The payment shock is going to be enormous, and not everyone will be able to absorb it. Repossessions remain relatively low for now, but there's genuine concern that we could see them spike in the coming months. Developers and construction companies are already pulling back hard. New housing projects are being delayed or cancelled outright because the economics no longer make sense. When you're building homes to sell and prices are falling, your profit margins evaporate or turn into losses. Planning permissions that were granted months ago are sitting unused. Building sites that were bustling with activity have gone quiet. This has immediate implications for employment in the construction sector, which is one of the UK's largest employers. It also has long-term implications for housing supply. Britain already has a chronic shortage of homes, and if construction grinds to a halt now, that shortage will only get worse. When the market eventually recovers, and it will at some point, we'll face the same supply-demand imbalance that drove prices to unsustainable levels in the first place. The cycle will repeat unless something fundamental changes in how we approach housing policy. Renters might have hoped that falling house prices would lead to cheaper rents, but that's not happening. In fact, rents in many parts of the country are still climbing. This seems counterintuitive, but it makes sense when you dig into the dynamics. Landlords who are selling up and exiting the market are reducing the supply of rental properties. At the same time, people who might have bought homes are now stuck renting because they can't get mortgages or don't want to buy into a falling market. So rental demand remains strong even as the sales market collapses. Landlords who are staying in the game are passing on their higher mortgage costs to tenants in the form of rent increases. Renters are caught in the worst of both worlds, unable to buy because of high mortgage rates and unaffordable house prices, and unable to save because rents keep eating up more of their income. It's a trap with no clear escape route. Some opportunistic buyers are starting to circle, sensing that real bargains might be available if they time it right. Cash buyers, particularly older individuals who have paid off their mortgages or built up significant savings, are in a strong position. They don't need to worry about mortgage rates, and they can move quickly when they spot a property that's been heavily discounted. Foreign investors are also beginning to show renewed interest, especially in London, where prices have fallen sharply and the pound remains relatively weak. For someone buying in dollars or euros, UK property is starting to look like a potential bargain. However, most ordinary buyers are still on the sidelines, paralysed by uncertainty. The fear of buying now only to watch prices fall another 10 or 20% is too great. This wait-and-see mentality is extending the downturn because without buyers, prices have no floor. Negative equity is becoming a real problem for homeowners who bought at the peak of the market in late 2022 or early 2023. If you purchased a property for £400,000 with a 10% deposit, you owe £360,000 on your mortgage. If that property is now worth £350,000 because prices have dropped, you're in negative equity. You owe more than your home is worth. This makes it almost impossible to sell without bringing cash to the table to cover the shortfall, and it locks you into your current mortgage deal even if better options exist. For young families who stretched themselves to get onto the property ladder, this is devastating. They did everything right, saved for years, got approved for a mortgage, bought a home, and now, through no fault of their own, they're trapped. The psychological impact of negative equity is profound because your home stops feeling like an asset and starts feeling like a financial burden. What's truly shocking about this crash is how avoidable it might have been with better policy decisions. Interest rates were held artificially low for over a decade, which fueled a borrowing binge and sent property prices to absurd levels. When inflation finally forced the Bank of England's hand and rates had to rise, the adjustment was always going to be painful, but the speed and severity of the rate hikes have amplified the pain unnecessarily. There's a growing argument that a more gradual approach, even if it meant tolerating slightly higher inflation for longer, would have allowed the housing market to adjust without crashing. Now we're dealing with the fallout of a hard landing that's hurting millions of households and threatening the stability of the broader economy. Central bankers will defend their decisions by pointing to inflation targets and economic models, but for ordinary people watching their wealth evaporate, those justifications ring hollow. The long-term implications of this housing crash are only just beginning to come into focus. Entire generations of young people are being priced out of home ownership permanently. If you can't get on the ladder in your 20s or 30s, it becomes exponentially harder as you age. Renting indefinitely means you're never building equity, never benefiting from capital appreciation, and facing housing insecurity well into retirement. This is creating a new class divide in Britain between those who own property and those who never will. The wealth gap is widening, and housing is the primary driver. Property ownership has been the most reliable way for ordinary families to build wealth in the UK for generations, but that pathway is closing off. What replaces it? Nobody knows. Without the ability to accumulate wealth through property, how do people save for retirement, fund their children's education, or weather financial emergencies? These are questions without good answers right now. Political pressure is starting to mount even if the government hasn't acted yet. Opposition parties are beginning to talk more aggressively about housing policy, promising interventions to stabilise the market and protect homeowners. There are calls for emergency support packages, temporary mortgage payment relief schemes, and measures to prevent mass repossessions. Whether any of this will actually happen depends on political will and fiscal capacity, both of which are in short supply. Elections are on the horizon, and housing will be a major battleground issue because it affects so many voters directly. Whoever can offer a credible plan to fix the housing crisis without bankrupting the country will have a significant advantage. But credible plans are hard to come by when the problems are this deep and this structural. International comparisons show that the UK is not alone in facing housing market taboo. Lents, Canada, Australia, New Zealand, and several European countries are all dealing with similar issues of overvalued property, rising interest rates, and falling prices. In some ways, this is a global phenomenon driven by the same forces: ultra-low interest rates for years, followed by rapid tightening to combat inflation. But the UK's situation is particularly acute because of the unique structure of the British mortgage market. The prevalence of variable rate and short-term fixed-rate mortgages means that rate increases hit homeowners much faster and harder than in countries where 30-year fixed mortgages are the norm. British households are more exposed, more vulnerable, and feeling the pain more acutely than many of their international counterparts. Predictions about where the market goes from here are all over the map. Some analysts believe we've already seen the worst of the falls and that prices will stabilise over the next few quarters as the market finds a new equilibrium. Others warn that we're only in the early stages of a much deeper correction that could last years. The truth is, nobody really knows. Housing markets are notoriously difficult to forecast because they're driven by psychology as much as economics. Confidence, fear, sentiment, all of these intangible factors play huge roles in determining whether buyers step forward or stay away. Right now, sentiment is extremely negative. People are scared, uncertain, and cautious. Until that changes, it's hard to see how prices stabilise, let alone recover. The crash might be over when it's over, but we're not there yet. What's clear is that the UK housing market has entered a new and uncertain chapter. The assumptions that guided buyers, sellers, investors, and policymakers for the past decade have been shattered. Property is no longer the guaranteed wealth-building machine it once was. Risk is back in a big way, and complacency has been replaced by fear. For some, this crash represents opportunity, a chance to finally afford a home or invest at lower prices. For many more, it represents financial devastation, the destruction of wealth, security, and dreams. The experts got it wrong, but the people paying the price aren't economists or analysts. They're ordinary families trying to build a life. And right now, that's harder than it's been in a generation.